If you're an income investor, there's a lot to like about preferred stocks. Mostly it's the consistent dividends, but also it's the safety of those dividends. Today we'll look at why preferred stocks missed out on this year's market rally, and more importantly, two major opportunities for higher returns when the Fed pivots. And I'll also give you some examples of preferred stocks I just started buying. The preferred stocks are like a hybrid of common stocks and bonds. Income investors are drawn to common stocks that pay dividends, and some companies have a reputation for paying consistent dividends, but they're not actually obligated to pay any of these. During tough times, cutting or suspending the dividend is always an option. Preferred stocks also offer dividends, but the amount paid is determined in advance. It typically begins as a fixed percentage of $25. For example, 6% of $25 equals $1.50 per year. Some preferreds will remain fixed and some will switch to a floating rate after, say, 5 years. An example of a floating rate would be 2% plus SOFR, that's Secured Overnight Financing Rate. SOFR is currently 5.3%, so that would equate to a yield of 7.3%. If that switch happens, the dividend paid will start to vary over time. But unlike a common stock, the dividend won't be determined by the company, it'll be determined by the interest rate market. If you're wondering which companies issue preferred shares, they're not evenly distributed. Banking and finance are the meat and potatoes for preferred stocks. These 5 sectors dominate preferred stocks. After that, it's pretty slim pickings. Apart from the predictability of the dividends, why else would you want to buy preferred stocks? A side effect of the predictable payouts is preferred stock prices are less volatile than common stocks. Another benefit of preferreds is they offer some upside beyond the stipulated yield. For example, if the price of a $25 preferred stock with the 6% yield I mentioned earlier drops down to $20, the $1.50 dividend doesn't change, so the yield increases to 7.5%. In other words, timing matters. If you buy a preferred at the right time, you can receive a higher yield than it paid when it was issued, and there are some other upsides that we'll get to shortly. The flip side to that appreciation is that compared to a common stock, the upside for a preferred stock is limited. Under certain circumstances, a company can buy back the preferred stock. This is known as calling the stock. Typically, the price they'd pay preferred holders is the $25 par value. If you bought the preferred for $20, then being forced to sell it for $25 is okay. But you can see why there's not really much incentive to pay more than $25. The third major reason to buy preferreds is that compared to common stocks, they get VIP status or priority in 2 situations. First of all, during financial stress, if a company wants to cut or suspend the dividend, they're required to cut the common stock dividend first. Cutting the dividend for preferred stocks is the last resort. Secondly, if a company goes into bankruptcy, preferred stockholders are one step higher in the order of creditors than common stockholders. This one isn't much of a benefit because common stockholders are at the bottom of the creditor order of claims, so being one step above them isn't really saying that much. The price of preferreds has fallen steadily since early 2022, which is why you don't really hear people talking about them at the moment. The reason for the drop is that preferred pricing behavior is similar to long-term bonds. They move in the opposite direction to interest rates. If interest rates were low, let's say 1%, then a preferred issued with a 6% yield was attractive and could hold its $25 price. But then when interest rates increased to 5%, investors could get a similar return from treasuries with zero risk of default. So there was selling pressure on preferreds and their prices fell. And this is why many preferreds are now currently trading at below their $25 par value. The obvious upside for preferreds is that when the Fed pivots and interest rates fall, the price of preferreds will rise. They won't rise indefinitely. There will be a soft ceiling of $25, but the lower the rates go, the closer they'll move to their $25 par value. Before we move on to upside number 2, a quick disclaimer, I'm not a financial advisor. Since retiring in 2017, I began researching my investments in far greater depth because, well, they pay for everything. When I find something interesting, I make a video. Upside number 2 is less obvious. A portion of preferreds include a provision to switch from a fixed rate to a floating rate. We'll look at a fund shortly where this applies to just over half of the preferreds in the portfolio. Interest rates are at their highest level now in more than 20 years. So any preferreds issued in the last 20 years that reset to variable rates will switch to a rate that's higher than their fixed rate. Here's an example. AGNCN was issued in 2017 at $25 and paid a 7% fixed yield. When it reset to a variable rate in 2022, the formula was LIBOR plus 5.1%. That's currently over 10%. And here you can see where the quarterly dividend shot up from 44 to 57 cents and then continued to climb to 65 cents. AGNCN preferred holders saw their income shoot up dramatically, and you can guess what happened to the stock price. It climbed up from $22.32 up to the par value, and then actually even a little bit beyond that. I've been telling you how crappy preferred prices have been lately, but this is an exception. The increased dividend and the price increase has given this preferred stock a total one-year return of 15.29%. Not bad. This example came from an excellent article written by Dirk and Carol Leach on Seeking Alpha. By the way, I never buy a stock or fund without first researching it on Seeking Alpha. I'll put a link to a free trial in the description and a link to the article that I just mentioned. Let's take a look at a few ways to buy preferred stocks. If you want to dip your toe in the water and you have no idea where to start, you can buy an ETF that holds hundreds of preferred stocks. The largest preferred ETF is PFF. It's currently yielding 6.93%, and it's been around since 2007. Here are the dividends since inception, and they look pretty solid. The pros are diversification and high trading volume, so you can buy or sell anytime without worrying about slippage, which is the gap between bid and ask price. The cons are it's a passive index fund, so the 400 plus holdings might not be the best preferred stocks, nor are they traded at the optimal time. It's designed to just reflect the overall preferred market. If you want a higher yield, example number 2 is currently paying 10.11%. The yield is higher because it's 20 to 30% leveraged. The cost of that yield is more volatility. If you want to know which of these two funds produces better total returns, it's a question of timing. This chart also shows how the leverage makes PFFA more volatile than PFF. I should also note that unlike PFF, PFFA is actively managed. When you combine that with the cost of leverage, PFFA has much higher fees, 0.46%, versus 1.4%. By the way, PFFA is the fund with roughly half its portfolio shifting from fixed to floating. Of that half, about 80% will make the switch by the end of 2025. Each time that happens, it's a boost to the dividend from that holding. If you like preferreds, but you don't like paying management fees, you can just create your own portfolio. If you're passionate about it, you can potentially generate returns better than the funds because you can buy thinly traded preferreds that the funds can't. You can also get better tax treatment on individual preferreds because the dividends are typically treated as qualified income. Funds tend to have more ordinary income. RC Series E is an example of an individual preferred stock. It was issued by the business development company Ready Capital with a 6.5% fixed yield on its par value of $25 and is currently trading at $19.15, so the current yield is about 8.5%, which is pretty good. I touched on the basics, but if you want to do a deep dive into preferred stocks, there are more layers and more opportunities to boost returns. It can get pretty overwhelming, so here are some resources I'm using to make sense of it all. Systematic Income Investing provides some basic information on their website, including a 40-page guide to preferred stocks. I'll include a link to that guide in the description. I found it pretty handy. This subscription service offers an enormous database of information. There are preferred portfolios at various levels of risk. I think there are 3 from memory, and some extremely detailed analysis tools. You can analyze all the data for, say, banking preferreds versus insurance preferreds, then drill down to detail on an individual preferred stock. They also email a daily report on what's happening in the market and any opportunities that they've found. It's $29 a month. It also covers other investment categories, including REITs and BDCs. I've had it for a few months, and so far I'm pretty happy with it. The second resource I've been using is a service I found on Seeking Alpha called the REIT Forum. They cover REITs, BDCs, and preferred stocks, and MREITs. They provide portfolios and trade updates too. Not as many analysis tools as Systematic Income. Their specialty is detailed analysis of the stocks they track in an email format. For example, when ARCC releases quarterly earnings, they pore over the earnings call and all the financial statements and issue a report that helps you make sense of it all. It's $75 a month or $50 per month if you buy a year. It's not cheap, but every few weeks I'll come across something so useful that I haven't really been able to cancel the service. If I'm still using it by the end of the year, I'll bite the bullet on the annual membership, $600. Yeesh. For preferred stocks, I use the tools on Systematic Income and the portfolios from both services. For BDCs, I focus on the reports from the REIT Forum. I think Seeking Alpha is a good all-round resource for income investors, but these two services are really hardcore, so they won't make sense for everyone. If you want to do a deep dive into preferreds, BDCs, REITs, and MREITs, I'll put a link in the description. Just for disclosure, I have an affiliate relationship with Seeking Alpha. I don't have any relationship with Systematic Income or the REIT Forum, other than being a customer. I bought a small amount of the PFFA ETF to get some diversified exposure to preferreds, but the more I research, the more I lean towards building my own basket of preferred stocks rather than relying on a fund. It'll take some time because there's a lot to learn, but there's no rush. For individual preferreds, I bought RC Series E, the one I mentioned before, and NLY Series F, but don't buy those just because I bought them. I'm still learning about preferred stocks, and I'm just sharing what I'm learning because I think it's interesting, not because I think I'm the expert. These were small buys that add up to about 1% of my portfolio. If I find enough opportunities, I could see preferreds becoming at least 10% of my portfolio. The Fed might not pivot for another year. Who knows? If I'm too early, I'll get paid 8% plus to wait, and I'm okay with some further price deterioration in the interim. Over the long term, preferreds can't compete with the S&P 500 because their upside is limited. That's over the long term. However, during a period of falling interest rates, there's an opportunity for this asset class to produce some excellent returns. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find videos of my favorites, I made a playlist to save you some time. That wraps it up for this look at preferred stocks. More Armchair Income coming soon.